What's up everyone, it's Scotty with Money Investing. So in this video, wanted to talk a little bit about how large institutional investors are still incredibly pessimistic about the stock market, so much so that they are now the most underweight equities in over 14 years, since 2009. So hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. If you're just joining us for the first time, the link to our Discord and Patreon is going to be down below if you're interested in joining us. And of course, getting access to all the buy and sell alerts, options alerts, trade ideas, everything is going to be included. There is a 16% annual discount that does expire and go away at the end of this month, and you'll get access to all the private videos and all the member benefits as well. So this right here is a video that I did not too long ago, and we've been talking about the market breadth for quite some time, right? So if you've been part of the channel for some time, we've been talking about market breadth and how this has been a very, very concentrated rally. After this video is over, make sure that you do check out this one I posted 3 days ago, running for the exits, which gives you a little bit more visual representation of how institutionals and retails are kind of positioning themselves in the current market environment, and how institutionals kind of selling into this rally and how retail is kind of buying into this rally, and what the consequences might be in the future. So definitely do check out that video if you have the time. Now this right here is again the NASDAQ 100, and how only 7 companies kind of make up over 50% of the NASDAQ 100. I think they make up a little bit over 25 to 30% of the S&P 500, and the NASDAQ composite's kind of like in a very similar 20-25% number. But the bottom line is that most companies in the S&P 500, the NASDAQ, or the Dow Jones don't make up a majority of those indexes, right? Because it's only a handful of big tech companies, and because these companies have performed really well, and combined they have gained a little bit over $2 trillion in market cap, the 40 largest companies in the S&P, has really what resulted in the markets pushing higher since October, not to mention since January of this year in 2023. Now this right here is another really interesting chart that goes over NASDAQ, specifically new highs versus new lows, and this is going to be ticker symbol NAHL if you want to look that up for yourself. But really what this shows you, that this is a nice net indicator, which shows us how many stocks in any particular day are actually making new highs versus new lows. And what you'll notice is that since February, over here you can see the timeline, since February, this has been making lower highs. In fact, it has been coming down and making lower highs, while at the same time the markets have actually been moving higher. The NASDAQ is moving higher. This right here is once again NAHL. You can see the NASDAQ new highs and lows index since 2020, since October of 20, I think it's since the beginning of 2022. You can see that this number has been coming down, and so did the market. Of course, it rallied all the way lower, but then you'll notice that it has been selling off even further as the markets continue to push higher. So I think it's a weekly chart right now is what we're looking at. It's going to be a much longer time frame, and what you have over here is that obviously a lot more stocks started making new lows versus new highs because of the entire bear market in 2022, and of course going into 2021 and 2022, and the market started selling off because of the rise in interest rates from the Federal Reserve. And as this index was coming down, the markets was coming down. That's pretty obvious. But then over towards the end, you can see that 2023, since April, you'll notice that this right here is the sell-off, that we're seeing additional sell-off while the markets continue to actually push higher over here. So that's the discrepancy that I wanted to also go over. But the more important thing here is that investors most underweight stocks versus bonds since 2009. So in the most bearish survey of this year, this actually came out just a few days ago, the first after banking turmoil roiled markets last month, investors indicated that fears of a credit crunch and driven up bond allocation to net 10% overweight, the highest since March of 2009. A net 63% of participants now expect a weaker economy, the most pessimistic reading since December of 2022. So this is a global survey that Bank of America does with a lot of fund managers, and this is pretty much globally. And still, the bearish in turn sentiment is a contrarian signal for risk assets. So again, you can kind of see it from both an optimistic lens or a pessimistic lens. Pessimistic because, well, the consensus right now, or the sentiment and the action, is very bearish. But this can also act as a contrarian signal because it's all bearish, you may want to take the other side of the bet, which is start betting on stocks, or pretty much start going long and be bullish in the market. So again, it really depends on what you think, right? And Michael Hartnett pretty much mentioned in that note that if consensus lust for recession isn't satisfied in the second quarter, the pain trade would be a rally in the bond yields and bank stocks, he said. And Hartner was correctly bearish through last year, warning through growth fears would fuel a stock exodus as well. And this right here is another chart that pretty much mentions that right now we're the most underweight equities since 2009 relative to bonds. So on a relative basis, net percentage overweight equities versus bonds, the lowest level in April of 23 compared to the last time you saw that was back in March of 2009. Now, if you come over to the S&P 500, and if you do some very simple analysis of where we were back in March of 2009, you'll notice that we were actually coming towards the bottom of the market, right? So if you come back to the great financial crisis here, and you'll notice that this right here is going to be that sell-off, the entire sell-off that we saw. And you'll notice in March of 2009 was pretty much the low point of this great financial crisis, right? So you can kind of compare this chart to this March of 09. Investors or on a more, aggregate basis, institutionals and large money managers, fund managers, they were the most underweight stocks relative to bonds at the worst possible time, because this right here was literally the bottom for the great financial crisis. And since then, we kind of kickstarted this massive bull market that's lasted us for the last 13, 14 years. Of course, we've had bear markets here and there, but overall, we've seen the markets go higher. And again, we're seeing very similar, weighting or allocation among large money managers, fund managers on an aggregate basis at the moment since 2009 in April 2023. So this right here are going to be some of the results from those respondents. So about 84% of respondents see a pullback in global consumer price inflation, while 58% predict lower short-term rates, the most since November of 08. About 80% expect the U.S. debt ceiling to be raised by September. Cash allocation has remained above 5% for 17 consecutive months, second only to 32 months during the dot-com bubble bursting in the bear market of the dot-com bubble. A net 49% of investors expect investment-grade bonds to outperform high-yield bonds over the next 12 months, the most on record, and U.S. European commercial real estate seen as the most likely source of a credit event, followed by U.S. shadow banking, U.S. corporate debt, and treasury debt downgrade as well. And most crowded trades are, of course, your long big tech stocks, short U.S. banks 18%, long China equities, short REITs, and long European equities, and long U.S. dollar as well. But the most crowded trade is pretty much the long big tech stocks, which is what's driving or fueling this entire bull market, or not really a bull market, but the rally that we've seen since October, since January of 2023. So this is where we have seen a little bit of consolidation, a lot of concentration happening in that sector or in that part of the market, which is what's driving the markets higher, obviously, since October and January of this year. But let me know your thoughts down in the comment section below. I see it a little bit more from an optimistic lens, where if we are underweight equities on a more broader scale, that only represents an opportunity to dollar cost average and, of course, buy at your fair value, not going crazy at any prices. But of course, if prices do come down at the fair value, that gives us the opportunity to dollar cost average and, of course, establish a bigger position, because in the longer term, that's going to work in our favor once the money starts flowing back into equities, because we also do know that institutions, hedge funds are literally net short right now on S&P 500, the most we've seen since 2007, 2008 as well. So again, hope you guys enjoyed this video and a complete update on the markets. Let me know your thoughts down in the comment section below. What do you make of this data? What do you think of the fact that, once again, on a relative basis, institutions are, most net underweight equities versus bonds? Again, let me know in the comment section down below. As always, happy investing. Make sure that you drop a like, subscribe to the channel. Link to our Discord and Patreons down below with a 16% annual discount. So always happy investing. I'll see you all in the next video.